Hi, and welcome to this morning's early, concise highlight video analysis. It is currently 6 a.m. U.S. Central Time on Friday, February 5th, U.S. Employment Report Friday. And what we know is that little has changed on quite a few markets in spite of the swings since our extensive Wednesday global view with the updated market observations that were added Thursday morning after the Bank of England inflation report press conference. And so we'll be covering just the S&P 500 and the select critical foreign exchange aspects today. But we also know, especially in the wake of some additional Fed comments on Wednesday, is it's a bad news is good news equity market. And that's shown up quite extensively over the course of this week. So we have to ask, what has all this meant to the markets? And we're going to only cover, as we said, the S&P, because it's tending to lead the other weaker equities, tending to be an influence on them. And as usual, we start with the short-term view, hourly on the left, 30-minute on the right, of the S&P 500 future. And what do we know so far today? Markets parked in front of the employment number. We're currently up a couple bucks at around 1910. And the important things to keep in mind is there's an interim level. The market's been above and below here at 1902 to 1895. Now, that's also important because you had an 1895 area low on the pullback on Thursday after the opening, and that held various dips subsequent. However, the bigger, more critical lower support remains down in the 1865 to 60 area. Just to blow this hourly chart up for a minute, you can see how that was a fresh up break coming back up into, and then after the extended influence of the ECB press conference going back to a couple weeks ago on Thursday. And that's important because of the way the market gapped above it that Friday and has not been back down to close that gap. Lows are holding near 1865 or right into it, and especially as the overall upward channel, since that diabolical devolution on the Wednesday before the anticipation the ECB would be more accommodative, which it was back on Wednesday the 20th, got all the way through lower supports like 1860 to 65 and 1830 and 1813 all the way to 1804 before the market cleaned up markedly later in the day. And that overall upward channel, as we came in on Wednesday, was up to just about the 1865 area. And this Wednesday break was course on the back of the Tuesday comments. We don't know why it didn't bite until Wednesday from New York Fed President Dudley that maybe things were weaker in the U.S. than the Fed had imagined when it put through that first rate hike in almost a decade back on December 16th. And on one hand, you'd say, well, the Fed's more dovish, but much as we saw back out of mid-September, if it's dovish because things are weaker than they expected and they actually already put through the rate hike, that's not a good indication. But today, what we'd be looking for on the report is if it's weaker than expected, it might attract some reflexive selling. You might dip below 1895, in fact, but you have to remember it's a bad news is good news market. This market's going up right now because it can't stay down on breaks with central banks getting more accommodative. And that pretty much does it for the short-term view of the S&P 500. And it is important to look at the monthly chart right now, and that is because it is also showing the way in which that 1865 to 60 is very important on the major Fibonacci retracement, this duplication of the one we saw on the weekly chart, but also it was the September trading low right before the bad news is good news psychology back then, after the September FOMC meeting into the end of the month, knocked it down to that level. Even a very weak early October employment report put the market up. And if the Fed's getting more accommodative, we could see the same type of psychology here. And you'll note the way it actually, because of the extent of this break, did try to break down below 1865 to 60, couldn't maintain it into the later part of January, and that left it set up to be a false down break, at least for the near term. That could reassert itself on the downside later, but then ended up cleaning up, and this is where you get the idea you might even get back up to the more aggressive channel off the 2011 low, down break up in the 2015 area. Of course, this broader channel is very important, and whether they continue to respect it as support or at some point end up back below 1865 to 60, because using this topping line out of 2010 and again more recently out of late 14 and early 15, this is actually the overall upward channel from the low back at the cyclical bottom in March of 2009. And that pretty much does it for the S&P 500 future.